Well, good morning. First of all, want to thank Jim and the folks at KACo for putting on this great event, as well as allowing us to discuss things this morning. Um, we are going to briefly talk about investment strategies today. Specifically, we know that most of you all in the room today have reserve balances, whether it's general fund or other funds, that are likely greater than the reserve balances you all had 2 years ago or 4 years ago or 6 years ago, in part because of all the different federal buckets of money that have trickled down your way, whether it's CARES Act or ARPA Act. You all are sitting on, or a lot of you all are sitting on a lot of the money. And you couple that with the fact that short-term interest rates are at 12-year record highs. It actually presents a really attractive option for you all to optimize your investment options and generate some income for your counties that does not require any sort of tax increase. So today we want to talk just a little bit about what kind of options that you all have as counties to invest money in some of the strategies that we recommend for you all going forward. So in terms of just a general update on the investment side, as all of you all know, interest rates are higher, much higher this year than they were last year and in previous years. And this is a result of the Federal Reserve increasing their benchmark lending rate as a way to combat inflation. So if you look at the federal funds target rate today, which is 3.75 to 4%, and compare it to last year, it's a massive increase. We were effectively at 0% last year, and right now we're close to 4%. And there's additional Fed hikes that will likely come down the pike in the coming months. So short-term interest rates are way up because of what the Fed is doing and what the Fed will continue to do in the coming months to combat inflation. So I have two charts I want to show you all real quick, just so you get an idea of how drastic the interest rate change has been, both in terms of the increase and in terms of the timing itself. So the first chart we've provided is the AAA rated municipal bond rates year over year. So from November of last year to November of this year. So this is effectively what you all borrow money at for your various projects. So 1 year ago, it's represented by the red line on the bottom for years 1 through 30. So just to kind of summarize the borrowing cost, if you all borrowed money last year for 20 years, it would cost you all anywhere from 1.5% to 2% all in. If you fast forward to today, which is shown on the blue line, we have this drastic increase where those rates are closer to 5% today. Maybe some of you all can borrow a little bit less if you're a stronger credit, but you effectively went from 1.5% and 2% to 5% within a 12-month period. If we look at short-term treasury rates, so this is really, when we talk about investments, this is what we're talking about. Short-term investment rates from January through November, you can see that the 6 and 12-month U.S. Treasury rates were effectively just under 0.5% last year. And they have consistently increased month over month to where we're at today, which is about 4.5%. So very quick, very drastic changes on the interest rate side. So what does all this mean for you all? So again, today we want to talk just briefly on investment ideas and strategies for you all to optimize your funds. So in terms of what you all can invest in, that's outlined by KRS 66480. It's a pretty extensive list of investments. But from a practical point of view, there's really only 4 or 5 vehicles that 99% of you all utilize on a daily basis. I would say first and foremost, a collateralized deposit account, sweep account, or any interest-bearing account at your local bank is what all of you all utilize for at least some of your funds. That's the most common eligible investment in 66480. It's basically any bank account that's collateralized. You all can also invest in U.S. Treasury and agency notes. You can issue in bonds issued by the state of Kentucky or by other states if they have a high enough credit rating. And you can also invest in money market and funds that have underlying securities that are eligible. So for example, a money market fund that's invested in treasuries is a permissible investment. So if we actually take a look at those actual rates, this is what you all should expect to get in terms of investment returns with these products. So on the left side, we're showing treasury rates for various periods, 1 month through 2 years. So you can see that 3 month, 6 month, 12-month treasury rates are anywhere from 430 to 464. It's a very attractive return. And then on the right side of this slide, we're showing products that offer daily liquidity. So these are those sweep accounts or money market accounts that you all can actually use to operate your budgets and can move money around on a daily basis. Those liquid accounts will yield anywhere from 3 to 3.5% under current market rates. So it depends on your bank, it depends on the money market, but generally speaking, you can expect to get between 3 and 3.5% on those products. So to tie this all together, in terms of an investment strategy and things that you all specifically need to be looking out for and thinking about when you look at your reserves and investing your reserves, first and foremost, we look at 3 core concepts for investing your monies. Number 1 is preservation of capital. Number 2 is liquidity. And number 3 is investment return. So first and foremost, make sure that whatever investment you all choose, that it's a safe investment and that you all expect, worst case scenario, you put $1 in, you get $1 out. That's the number 1 goal. The number 2 goal is liquidity, is to make sure that you have enough cash or cash equivalent investments to operate your day-to-day operations of the county, to fund projects, to make debt service payments, etc. This is very important that you have enough cash equivalents to do that. And then finally, once those first 2 have been considered and achieved, we then look at return and how you can increase yield on your investments. So from a practical point of view, what this really means under current market conditions is 2 things. First and foremost, we recommend and think that you all should utilize a government money market account or sweep account for your daily activities. So this would be an investment product that you all can use to operate day to day, that you can move money around day to day and expect a yield greater than 3%. And then secondarily, it makes sense to go out and buy CDs or treasury bonds 3, 6, 9 months out to pick up investment yield. And these specific securities, in theory, would align with project expenses on your side. So right now, I imagine a lot of you all are either at your most flush period or will be in the coming months as your tax receipts come in. And I know a lot of you all know that you have project expenses or general expenses coming up in, let's say, May or June. The idea behind this second concept is to go out and buy a treasury bond that matures in April, pick up some additional yield. When that security matures in April, you can then use it to fund that expense in May or June. So I wanted to show you all a real-world example of kind of how that would work. So we chose a project fund example. So if you all are working on a hypothetical $10 million project, it's got an 18-month construction period with level draws. How would that look and how would we structure that? So 1, we're going to look at putting your money in a treasury money market account that you have daily access to. We're going to look at buying U.S. Treasury notes around those construction draws. And then 3rd, we have a liquidity target of 30%, meaning that we want to make sure that 30% of all those funds are liquid at all times. So 30% of all future draws are liquid. So in the event that you will have some unexpected expenses or something happens, you've got dry powder to make those things, to pay for those things as they pop up. So the way that this works, or the way that this looks kind of mathematically, is you can see on this table here, and hopefully all you all can see this, is that under column A, we've got various dates over an 18-month period. Under column B, we've got the expected construction draws of this project. Again, it's a $10 million project. And then if you look under column D, we're buying $6.8 million in treasury bonds. So $10 million project, 6.8 in treasury bonds, 3.2 million will remain liquid in a money market account, which is yielding 3.54%. And then under column E, you can see where we have these treasury bonds maturing each month as those construction draws materialize. And right beside that in column F, you can see the corresponding interest rates with those purchases. So all we're doing here is we're tying your construction draws with the maturity of those securities, and we're leaving a big chunk aside in a money market account to cover any unexpected expenses. So if you look at the bottom of this page under column G and column H, you can see the interest earnings of $239 and $104,000. So from a summary level under this example, you would generate $343,000 in interest on this $10 million project in 18 months with a blended yield of 4.2% between the treasury purchases and the money market account. So that kind of gives you an idea of what to expect under this methodology of buying treasury bonds and having a liquid investment. I know that a lot of you all don't have $10 million laying around or have a $10 million project. But this same strategy can work for your general fund dollars. So if you have $5 million to invest in the general fund reserves, this same investment strategy would yield $170,000 over 18 months. So almost $10,000 a month. If you only have $2.5 million to invest, then we're talking, $86,000. So it is a pretty substantial amount of interest earnings that are out there for counties these days because of the increase in the short-term interest rate market. So just to summarize on our end, we wanted to provide you all with just some other considerations to think through if you all are interested in maximizing the investment of your funds. I think the most important thing here is that, investments are not just limited to large projects. If you all have, a couple $1 million of general fund reserves, if you've got ARPA money or CARES money sitting around, that money can be invested and you can maximize those dollars to generate interest for your county. We think that anytime you all are dealing with, more than a couple $1 million, you may want to consider bringing in some professional help and some advisors to help provide these options and manage this for you all. And then the third thing on this page, and I think this is probably the most relevant for you all in this room, is worst case scenario, you can always take this information that we're talking about today, and we'll be glad to send it to you, and you can use it to leverage your local banks to get a better interest rate. Because I know a lot of you all out there have great relationships with your local banks, and it would be problematic potentially to take deposits away from your local bank. So if you're in that situation, it's always good to look at treasury rates and some of the things that I just talked about and use that to leverage your local bank to increase your deposit rates. So if that's something that you all are interested in, please let us know. Please let KACo know. We do this all the time. We'll provide you guys with the summary, take it to your local bank, see if you can get a better rate from them. So that's all I have today. I know I ran through this quickly, but wanted to give you all a couple minutes just to see if you had any questions. Yes, sir. They were net of fees. So those rates were as of November 15th, which was 2 days ago, and they're net of all transaction fees. So it's a great question. So fees will vary all over the board. If you bring in an investment advisor that manages personal people's money, they're going to charge you 1%, and they're going to make a lot of money where they shouldn't. What we typically recommend for like $10 million projects is to negotiate a fixed fee ahead of time. So for $10 million, we would expect, anywhere from $7,500 to $10,000. Negotiate that up front instead of having them charge a fee every month to you guys. Thank you. Thank you, Jim.